So friends, let us now start with the currency convertibility, right? So we are in the era of globalization. There is movement of goods, people and capital across the border, right? So the movement of goods and services and the capital that involves the currencies of different countries. So for example, if Indian company like Infosys, they are exporting the IT services to the USA, then they will get US dollar as a payment. Or if I am importing TV from a country like China, I will have to pay the Chinese RMB as a form of payment, right? So for conducting all these transactions, the prerequisite is that the currencies of two countries, they should be able to exchange with each other, right? So I should be easily and conveniently able to convert the domestic currency into the foreign currency, or the foreign currency into the domestic currency, both ways, right? So the currency convertibility just means the convenience with which any resident or non-resident can convert the domestic currency into the foreign currency, or the foreign currency into the domestic currency, and this exchange should be at market determined exchange rate, right? So this exchange should be at the free market rate. There should be no precondition that you can convert only at this rate, right? So convertibility basically means that how convenience. So the first thing is that it is convenient to convert. Second, it is available for non-resident and resident. And third, it is available at market determined exchange rate, right? So this is the meaning of convertibility. Now, if I say any currency is fully convertible, right? So convertible basically means, first of all, there is no restriction about the purpose. So no one will ask me that what is the purpose of you converting the Indian rupee into the US dollar or US dollar into the Indian rupee. So there is no restriction on the purpose. There is no restriction on the exchange rate. So that means exchange rate is determined by the market itself. And third, there is no control over the quantity. So no one should say that you can convert only this much of amount. So any number of money can be converted. That level of freedom should be there, right? So purpose, rate and the quantity, in all the three dimensions, there should be no restriction at all. Then only we call any currency as the fully convertible, right? Fully convertible. So if in any country any of these restrictions is existing, then this is called partial convertibility, right? So for example, the country says, okay, if the purpose of convertibility is medical purpose, you can convert only maximum 2 lakh US dollar, right? So if you are putting the limit, then there is partial convertibility, right? then there is partial convertibility. If there is no limit, then there is fully convertibility. And third, if there is total ban on convertibility, then this is called no convertibility, right? Non-convertible regime, right? So there can be three kinds of regimes. First is fully convertible, second is partially convertible, and third, non-convertible, right? Now, in the balance of payment, there are two kinds of transactions. One is the current account transactions. Another category is capital account transactions. So, current account transactions, for example, the import and export of goods, invisible services, the transfers, gifts, right? So these are the current account transactions. Now, if the currency is fully convertible with respect to all the current account transactions, then we call it current account convertibility, right? Then we call it current account convertibility. So in case of current account convertibility, there is no restriction about the purpose, quantity, and the exchange rate if that is happening for buying the goods and services or selling the goods and services. So this current account primarily talks about buying or selling goods and services and certain other transactions, right? Capital account means buying or selling of some assets. So if I am Indian citizen, I want to buy one house in USA, I will send Indian currency and I will buy the US dollar from that currency, right? So first I will convert Indian rupee into the US dollar, and from that US dollar I will buy the home in the USA, right? So that transaction is called capital account transaction. So buying and selling of assets across the border. And this can be vice versa also. That means any USA citizen, if he or she comes to India and buys some assets in India, then that is also part of the capital account. Or it can also relate to loan. So either I am taking the loan from outside India, or maybe I am giving the loan to some person outside India. Both the cases are covered over here. Then third is all kinds of investments, the FDI, FPI, etc. So investable assets, right? So if there is no restriction on any of them, then this is fully convertible. If there is some restriction, then this is partially convertible. And if there is total ban, then it is non-convertible, right? So now you will ask, sir, what is the status in India? What is the status in India? So if we talk about status in India, first of all, we came up with the Foreign Exchange Regulation Act 1947. Under this, we put some huge restrictions. So at that time, we were, very closed economy. We were not that much open. So there was huge restrictions. Later on, this got diluted in 1990s and finally in 2002, and now we are quite liberal, right? So the legislative regulation of the convertibility happens through this Foreign Exchange Regulation Act, and now in 2002 this has been converted into Foreign Exchange Management Act, FEMA, Foreign Exchange Management Act. So earlier we said that we are regulating. So R stood for the term regulation. Regulation means the government is regulating. There is a check and balance. And now we are saying we are managing. That means we are not regulating, we are not putting much restrictions, but we are managing that there is sufficient currency inside India and there is not extra flow inside India, right? So now the government is working as the manager rather than the regulator. Coming to the current account convertibility and capital account convertibility. So if we see current account convertibility, in India we have 100%, or rather we should say fully convertible current account, right? And this is existing since 1994. So till 1990s this convertibility was very limited. So till 1990s we were having partial convertibility. In 1991 India faced balance of payment crisis. So the foreign exchange reserves in India were very low. We were not in a condition to even repay the payment for the import. So at that time we took the support of the IMF, International Monetary Fund, and IMF put many restrictions. IMF said that you have to open your currency convertibility. So as per the IMF conditions, we opened up the current account convertibility, or we made it fully convertible. However, with respect to capital account convertibility, in India what we have is partial convertibility, right? So there is some restriction. Sometimes it is about purpose, sometimes it is about quantity. So there is some restriction, but I am not saying there is total ban. So this is called partial convertible capital account convertibility. And to make capital account convertibility 100% or fully convertible, Tarapur committee was established, and this Tarapur committee has given recommendations twice, in 1997 and in 2007. So in fact this committee was established twice, and it gave the recommendation that India should open up capital account in a phased manner. Introduction. For the rapid growth of world trade and capital flows between countries, convertibility of currency is desirable, right? So if trade has to happen, that means sale and purchase of goods, that means import and export, and capital flows, so investment, loans. So if all these transactions have to happen, convertibility is desirable. Without free and unrestricted, that means there will be no restriction, right? Without free and unrestricted convertibility of currencies, foreign exchange, trade and capital flows between the countries cannot take place smoothly. To achieve high rate of economic growth and thereby to improve living standards, right? So if there is more trade, if there is more quantum of export and import, that will lead to more production in the different countries. When there is more production, it will lead to increase in GDP, and that increase in GDP will lead to increase in economic growth, right? So this economic growth rate will be higher. So to achieve high rate of economic growth and thereby to improve living standards, right? So if there is higher GDP, people will have more income, their purchasing power will increase, and ultimately their standard of living will increase. Through greater trade and capital flows, the need for convertibility of currencies of different nations has been greatly felt. The concept of convertibility, formally referred to as, so basically, as of now, convertibility basically means the convertibility between the the domestic currency and the foreign currency. Earlier, this convertibility basically meant the convertibility of gold into currency, right? So when we had the gold as the backup, at that time anyone will go to the government, give the currency and get the gold, or vice versa, right? So the concept of convertibility, formally referred to as referred in the year of gold standard and sometime thereafter to the right to convert the currency into the gold at a given rate of exchange. Nowadays, as of now, it means the ability of residents and non-residents, right? So we are talking both about residents and non-residents to exchange freely the domestic currency for foreign currency without limit, right? So there is no limit over the quantity, whatever is the purpose. So there is no limit or no restriction on the purpose also. Convertibility can apply to currencies of countries that have fixed or flexible exchange rate regime. So in both the regimes, this convertibility is applicable. What is the definition of convertibility? The facility of exchanging domestic currency for foreign currency at market determined exchange rate. So rate is market determined without restriction. So there is no restriction about the rate or the quantum of money which is exchanged, and there is no restriction about the purpose also. It refers to the rights of residents and non-residents to convert domestic currency into the foreign currency and vice versa, right? So this includes the right to convert Indian rupee into the US dollar or also the US dollar into the Indian rupee. Now there can be three kind of convertibility regimes. No convertibility, that means there is complete restriction, there is total ban. So it is possible in the countries like North Korea, which are isolated countries which do not have the free flow of business with different countries, and these are basically the closed economies. Example I gave, for example, North Korea, right? Full convertibility. So if there is no restriction at all for any transaction and without any limit, then it is 100% convertibility regime. Partial convertible, that means there is restriction. Partial convertible means there is restriction about the purpose and the magnitude of the transactions, right? So for example, in India there is no restriction on the current account convertibility, but there is restriction over the capital account convertibility, right? So there is restriction over capital account convertibility, but there is no restriction over the current account convertibility, right? So in India we have partial convertible regime, right? So in India we have partial convertible regime. Now, so types of convertibility, one is current account convertibility and another is capital account convertibility. Current account convertibility, that means there is no restriction on the convertibility of domestic currency into foreign currency or vice versa about all the transactions. In India we have this convertibility since 1994. In India we have partial capital account convertibility, so we don't have full capital account convertibility. So current account convertibility, that means the freedom of converting home currency into foreign currency with respect to transactions in the current account. In 94-95, the full convertibility in the current account was introduced. capital account convertibility, the freedom of converting home currency into the foreign currency with respect to transactions in the capital account. To bring capital account convertibility, SS Tarapur committee was set up, right? So to get the suggestions about capital account convertibility, SS Tarapur committee was set up in 1996 as well as in 2006, and it recommended that capital account convertibility should be implemented in the phased manner. So friends, there is a debate. Do we really need capital account convertibility? What are the benefits of capital account convertibility? So I am giving you 1 minute to think about what are the benefits of capital account convertibility. What are the benefits of capital account convertibility? So, first of all, capital account convertibility will mean that in India, anyone can invest any amount. So that will bring a lot of foreign exchange into India. Even Indian companies, they can invest any amount outside India. So Indian companies, they can convert themselves into the global companies. Right? So there will be easy flow of money. Secondly, if we compare developed countries' rate of interest to the developing countries' rate of interest, in the developed countries the rate of interest is quite low. In the developing countries, rate of interest is quite high. So for India, opening up of capital account convertibility will attract a lot of funds at a very cheap cost. So Indian companies can go abroad and they can raise amount of loan at a very low price. So this facility is very important. So the cost of funds will be reduced. Third, our international credibility will improve because we will be part of the free market mechanism, right? So we will be seen as the country which is free in all respects, right? So the international goodwill will enhance. So these are the benefits. What are the risks? The biggest risk is the sudden outflow of investment from India to outside India. So for example, if USA companies, they have invested into India, and in India something happens, or something happens even in USA, something happens outside USA also. So for example, recently the coronavirus issue. So because of this issue, the investors are taking out their money from the foreign countries. They are fearful about what will be the economic future of the world. So people are taking out their money from the stock market. The stock market of India is getting crashed. So this foreign investment, especially in the form of foreign portfolio investment, is a hot money which can create instability in the countries like India. It can lead to the rupee depreciation also, right? It can lead to rupee depreciation. So this kind of situation is undesirable. So there are risks basically, right? And these risks are not impractical. It has already happened in the East Asia. So in the East Asia, many countries, especially the Thailand, they have faced the heat in the 1998. So in at that time, these countries faced the sudden outflow of foreign exchange, the foreign investment from their country to the outside. The discussion that I did, let us see in detail. So the current account convertibility refers to the freedom in respect of payments and transfers for current international transactions. So the current international transactions, they relate to the exchange of goods and services. That means imports and exports, money transfers, right? For example, remittances. In other words, if Indians are allowed to buy only foreign goods and services, right? So they can buy only and only goods and services. But restrictions remain on the purchase of assets. So there are restrictions on the assets. So it is called current account convertibility. So you can see the all imports and goods exports of merchandise. Merchandise basically means the goods. Invisible exports and imports, that means the services like tourism, human resource services, financial services, software services, consultancy services, inward private remittances, pension payments, government grants. So all these are the part of current account convertibility. What are the benefits of current account convertibility? So one of the biggest benefit is in the form of boost to the export. And if there is boost to the export, that will lead to reduction in the another point is import substitution. So we can substitute import by importing the raw material and processing that into finished goods inside India, right? So rather than importing the finished goods into India, we can just import the raw material and we can convert that raw material into the finished goods in India. Incentive to send remittances from abroad. People who are working in outside countries, they can send remittances to the India. A self-balancing mechanism to current BOP. Self-balancing because if there are high imports, so in India there are certain things which cannot be reduced as far as import are concerned. So for example, the gold, crude oil, we will be importing anyways. So if there is full convertibility, exports can increase and it can provide self-balancing mechanism, right? So the import and export both can self-balance each other. Specialization in accordance with comparative advantage, right? So the countries can specialize in their strength. For example, in India we have highly educated workforce. So in India we can ensure the specialization of the workforce, for example into the information technology services, financial services, etc. So if there is easy flow of money for the purpose of import and export of services, then we can develop the specialization and we can get the comparative advantage as compared to the foreign countries. So in the foreign countries, the cost of providing these services is very, very high, right? So we can provide these services from India at a low cost. So this will provide a comparative advantage. Integration of world economy. The world economy will integrate. So nowadays we can see organizations which are operating different facilities in different countries. For example, this sports shoes companies, they buy the raw material from one country, they assemble in another country, they sell in another country. So their marketing office, assembly line, their head office, all of them are falling in different other countries because of easy convertibility of current account transactions. Now, capital account convertibility. So, capital account convertibility refers to the freedom of converting local financial assets into the foreign financial assets. So, local financial assets, for example, the investment that I have made, the properties that I have, so I can sell those properties and buy those properties outside India. I can take out my investment from domestic companies and make that investment outside India, and vice versa, right? And vice versa at market determined exchange rate. It refers to the elimination of restraints on international flows on a country's capital account, facilitating full currency convertibility and opening up of the financial system. So what are the different types of transactions? Inflows and outflows of capital. So it is in the form of foreign direct investment, foreign portfolio investment. So all these type of investment, they are basically inflows and outflows of the capital. Borrowing from or lending to abroad. So the transactions like external commercial borrowing or maybe trade credit. All these we have discussed already. Sale and purchase of securities abroad. Right, securities basically, for example, government bonds or maybe masala bonds. Etc. Capital account transactions, capital direct for investment, investment in securities, loans, short-term investment, we have already seen in the last slide. Now, there are many restrictions in India. So there are restrictions about the limit to companies borrowing abroad. So we have an upper limit with respect to the ECB, and this limit is actually $750 million. So in Indian company, they can raise the external commercial borrowing only to the extent of $750 million. Restriction on foreigners investing in India. So we have many restrictions. So in certain sectors, not more than 25% is permissible. In other sectors, just 49% is permissible. So depending upon the sector, there are certain restrictions on each sector. Restriction on amount of FII. Purchasing a company is allowed, but limit exit on the amount that can be sent. Global diversification of household portfolio is practically non-existent. So if I am an investor in India, it is very difficult for me to create a global asset base because of the very less convertibility on the current on the capital account. So friends, now we will start with the capital account convertibility, right? So we have studied the basic things about the capital account convertibility, and in India, to decide whether we should go for the fuller capital account convertibility or not, one committee was established. That committee was Tarapur committee, right? So this Tarapur committee was established, and it was established twice. Once in 1997 and second time in 2006, right? 1997 and 2006. For our discussion purpose, we will study about the 2006 report which was given by the Tarapur committee, right? So in 2006, Tarapur committee it came out with certain recommendations, right? So Tarapur committee told certain preconditions. That means before we introduce the full capital account convertibility, there should be some preconditions which should be satisfied, right? So these preconditions are regarding the fiscal deficit, the level of fiscal deficit as a percentage of GDP, the level of non-performing assets in the banking system, the level of cash reserve ratio CRR, the level of foreign exchange fluctuations, right? and so on. Apart from these preconditions, it also laid down certain recommendations. So the committee said that there should be improvement in the limit regarding the external commercial borrowings under the automatic route, right? It also put the restrictions on the participatory notes and so on, right? Now we will discuss each one of these in detail. So the Tarapur Committee on Capital Account Convertibility. So this capital account convertibility, we will call this CAC in short, right? So in short, we will call it CAC. Reserve Bank of India. So who appointed the committee? It was the Reserve Bank of India, RBI, the central bank. Appointed the second Tarapur committee, right? So the first committee came in 1997 and the second committee came in 2006 to set out the framework for the fuller capital account convertibility, that is 100% capital account convertibility. How to achieve 100% capital account convertibility. The committee was established to revisit the subject of fuller capital account convertibility in the context of, what was the context? Why we were talking about the capital account convertibility at that time? So India was moving at a very high economic growth rate in the 2006-7, right? There was no crisis at the global level and our economic growth rate was very high, our foreign exchange reserves were very high, and we were talking about liberalizing our economy to the next level, right? So this discussion was going on in the context of economic reforms, in the context of stability of external and financial sectors. Our external and financial sectors were stable and we wanted to make it more stable. Accelerated growth and global integration. We wanted more and more global integration. The report of this committee was made public by RBI on 1st September 2006. In this report, the committee suggested 3 phases of adopting the full convertibility of the rupee in the capital account. So 3 phases were suggested. The first phase in 2006-7, the second phase in 2007-9, and the third phase in the 2011. Now, why should the capital account convertibility be introduced, right? So the major purpose behind introducing the capital account convertibility is to attract more and more foreign capital at low cost, right? So friends, we are a developing country and we want to become a developed country. To move from developing country to developed country, we need good infrastructure. We need more share of the manufacturing sector. We need more airports, roads, railways, power plants, more industrial infrastructure, right? So all of that requires a lot of money, and the domestic availability of finances has a limitation. So we require the money from the foreign countries, the countries which are having the surplus capital, the countries like USA, UK and other European countries. So first thing is that more and more money can come into India. The second aspect is India being a developing country, the cost of funds here is very, very high. So in India, if you go and borrow for the business purpose, the loan is not available below 10%. So the cost of fund is 10% per annum. But if you go to the foreign countries, in the foreign countries like USA, the cost of funds is very, very low. It is as low as 2%, 3%. So the cost of capital gets reduced substantially. That means the cost of production comes down. And when cost of production comes down, we can export the products because our cost of production is less, therefore we can sell at low price. If we can sell the products at low price in the foreign country, then our export can increase, right? So two major aspects. One is the financial capital coming from the foreign countries for the domestic projects. Second, the money coming from the foreign countries at low cost, right? So these are the two prime considerations. So first, it was meant to ensure total financial mobility. So here the total financial mobility means the money is going from India and coming to India from rest of the world. So ROW here means rest of the world. It also aimed in the efficient appropriation or distribution of international capital in India, right? So international capital is available and it should be efficiently distributed and appropriated in India also, right? So in the era of globalization, where there is liberal movement of capital, goods and the people, the capital should go to that place where it can be utilized in the most efficient manner. And India is such country, right? India is one of such country because in India we have very low cost of manpower. The labor cost is very cheap because of the huge availability of the manpower, right? So first thing is that there is cheap cost of labor. Second, we have huge demand. So whatever is produced inside India, that can be consumed inside India itself, right? So cheap cost of labor and huge market, huge demand. These two are the most important aspect, right? So if we get the capital along with the labor and the market, then nothing like that. The government is already reducing its regulation. The country is moving from 3-digit ease of doing business index ranking to the 2-digit ease of doing business ranking, right? So we are even coming down, not coming down, we are actually improving in the index of ease of doing business, which is given by the World Bank. Preconditions. Now, as I told you that this Tarapur committee told some preconditions. The first precondition is the fiscal deficit needs to be reduced to 3.5% of the GDP. Now you might ask a question, sir, why this condition? So what is the meaning of fiscal deficit? That means the government loan, the government borrowing, right? So if government loan is reduced to 3.5% of GDP, that means our government is independent. The government is not dependent on the market. That means the government finances are stable, right? So the government finances should be stable. That is why the fiscal deficit should be within the limit of 3.5% of the GDP. Second, inflation rates needs to be controlled between 3% to 5%. So this condition we are able to meet because already after this flexible inflation targeting framework has been introduced after 2016, this inflation rates are actually inside the control. And even our flexible inflation targeting framework that says that our inflation should be between 2% to 6% and our inflation rate is already under control. As far as fiscal deficit is concerned, the fiscal deficit is also under control, but in the current year, because of the global slowdown and in the recent this corona crisis which is going on, because of this, in the budget itself, the finance minister requested that we should exercise the escape clause, right? So the escape clause was actually recommended by the encasing committee on FRBM review. So encasing committee said that fiscal deficit can be kept high in the global slowdown conditions or in exceptional conditions. The next condition is non-performing assets or the bad loans. Tara Pro committee says NPA should not be more than 5%. But in India, we are having the NPA crisis. Since 2014, we can see that NPA has been to the extent of double digit. It is hovering between 10% to 12%. Right? So this NPA crisis indicates that this precondition is not met. So earlier we were in the twin balance sheet crisis. The balance sheet of the corporates and balance sheet of the these banks, they were bad. Now we are in the four balance sheet crisis. That means the four balance sheet, the balance sheet of the corporates, balance sheet of the banking sector, balance sheet of the real estate sector, and balance sheet of the NBFC. I am repeating: corporate, banking, real estate, and NBFC. Four balance sheet are doing very bad. So we are in the four balance sheet crisis. We are in the cyclical slowdown phase. We are in the cyclical slowdown phase. So this NPA crisis condition is not satisfied, right? So this precondition is not satisfied. CRR needs to be reduced to 3%. So as of now, the cash reserve ratio, the amount which banks have to keep with the RBI, the percentage of NDTL, net demand and time liabilities, the percentage of net demand and time liabilities which the banks have to keep with the RBI, that is ranging around between 4% to 5%. So this condition is also not met. Now you might ask a question, sir, why this NPA condition is there and why this CRR condition is there. So low NPA and low CRR indicate that we have a strong banking system, that banking system can create more and more credit, right? So the low volume of the bad loan means our balance sheet are clean, and low value of the CRR means that banks can create more and more credit, right? Not much of the money is held. A monetary exchange rate band of plus minus 5% should be instituted. That means the fluctuation should be in the range of 5% only. But if we see the fluctuation is much more, it goes up to double digit during a particular year. So even this condition is not satisfied, right? So these three conditions are not satisfied. Only two conditions are to be set almost satisfied. That is the fiscal deficit and the inflation. The condition of the NPA, CRR and the foreign exchange fluctuation, these conditions are not satisfied. That means we need to wait before the capital account is converted to the extent of 100%, right? So we need to wait for the 100% capital account convertibility. Now, so these are the different three phases. We are not supposed to discuss this, but still if you want and you are interested, you can go through this. Now, what are the recommendations of the committee, right? So till now we have discussed why we require fuller capital account convertibility, and we also discussed that what are the preconditions for the fuller capital account convertibility. Now we are going to discuss what are the recommendations. The first recommendation is the ceiling or the upper limit for external commercial borrowing. External means from the foreign country, commercial means for the commerce, the business purpose, and borrowing means the loan. The loan which is taken by the businesses from outside India, that is external commercial borrowing. So the upper limit for the external commercial borrowing should be raised for automatic approval, right? So in case of ECB, there are two routes. One is the automatic route, that means there is no prior approval required from the side of RBI. Another is the approval route, that means there is approval required from the side of the RBI, right? So under the automatic approval route, in June 2019, this limit was raised to the extent of US dollar 750 million, right? So any eligible borrower can raise ECB to the extent of US dollar 750 million under the automatic route. NRI should be allowed to invest in capital markets, right? So NRI means non-resident Indians. So they are the people who are the citizen of India, but who are living outside India. The residence is outside India for the purpose of employment, business, etc. And they are living outside India for a minimum of 182 days or more during the current financial year, right? So during the current financial year, they are staying or residing outside India for a period of 182 days or more, right? So in that case, they are called NRI. And do you know the person of Indian origin? What is the difference between the NRI and the PIO? The person of Indian origin is basically not a citizen of India. So the PIO is a citizen of some foreign country, but the person has already been a citizen of India and surrendered the citizenship and acquired the citizenship foreign country, or the person has some roots inside India. What is the meaning of having the root? That means the parents or grandparents, they were the citizens of India. They were born in India, right? So the person of Indian origin is the citizen of foreign country, but has some linkage with India. The non-resident Indian, NRI, is the citizen of India, but residing outside India for 182 days or more during the current financial year, right? So this is how we differentiate between the NRI and the OCI, this PIO, person of Indian origin. So NRI should be allowed to invest in capital market. So they should be allowed because they have the emotional linkage. So they should be allowed at a very relaxed terms and conditions. NRI deposits, that means the deposits into the bank accounts, should be given tax benefits. Tax benefits means there should be no tax on the interest amount, etc. Right? So as much as possible, we should give them tax relaxation so that they deposit their money into the India's bank account, and we can get more and more foreign exchange money, right? So this is the second recommendation. Third recommendation, improvement of the banking regulation. That means banking reforms, right? So the banking reforms, it means the reforms about the governance of banking system, the system to reduce the risk of bad loan, to implement the information technology, banking merger, privatization of banks, right? So all these things needs to be kept in mind. So this kind of bank regulation should be enhanced, because if there is a strong banking system, then this fuller capital account convertibility will have low risk. Next is the FII, foreign institutional investor. So as of now, this is part of the FPI, foreign portfolio investment. So I hope you remember I discussed the concept of FDI and FPI. FDI and FPI, they were classified by the Arvind Mayaram committee, right? So this FII is basically part of the FPI. They should be prohibited from investing fresh money into the participatory note. Now, what is the meaning of participatory note? So I will discuss in the next slide itself. Don't worry. You need to just understand that FPI, they should be prohibited from investing into the P note, because these P notes are risky. They are the risk to the financial system. Next, existing PN holders should be given an exit route to phase out completely the PN notes. At present, rupees fully convertible in the current account, but only partially convertible in the capital account. So this fact we already know. So now we will discuss the meaning of the participatory notes. Let me tell you this concept. Participatory notes, that is P notes, right? So consider that this is the India, right? And this is basically inside India, this is the stock market of the India, right? That means in this stock market the shares trading takes place, right? The trading of the shares take place, the sale and purchase of the shares take place. Now this is suppose Singapore, and inside the Singapore there are some small investors, and these small investors, they want to invest into the India's stock market, right? So if anyone wants to invest into India's stock market, there is a precondition that the person should be registered with the SEBI. SEBI is basically the regulator of the share market. That means each one of these foreign investors, the individuals, they should be going to the SEBI in India, and they should register themselves. They should complete all the formalities, right? So that is basically this process of registration is a very difficult task. So to avoid this difficulty, all of these small foreign investors, they go to one foreign bank or some big investor, some institutional investor, right? And they say that please take our money and deposit our money or invest our money into the India's stock market. So suppose this investor, this bank, the foreign bank, it agrees that okay, I will invest on your behalf. So this bank, it will register itself with the SEBI. It will not register all of these people. So it will receive the money from foreign these small investors and invest this money into India's stock market. In return, this will issue the participatory notes to the small investors, right? So participatory notes are basically issued by the registered FII, foreign institutional investor, to those investors which are not registered. Now, what are the positives of this transaction? The positives of participatory note is that these small investors, they get an opportunity to invest into India's market. From the India's perspective, India gets a lot of foreign investment. So it's an opportunity to receive more and more foreign exchange. Now, what are the negatives? The negatives or the concerns, the concern is that because they are not registered, so the government of India, we do not have any information about who are these people. In many cases, they are the black marketeers. They are the people who are holding the black money. They are the people who are involving into the terrorism activity. They are the people who are involving into the money laundering. Money laundering means converting the black money into the white money, right? So the profile of these individuals is under suspicion. So to avoid this suspicion, to avoid the risky transaction, the government actually avoids the investment through the participatory notes, right? So to avoid this kind of situation, the government is avoiding, prohibiting, or if not prohibiting, at least increasing the restrictions, increasing the know your customer norms, increasing the formalities before these people can invest into India's market, right? So this is the reason why participant notes are the reason of concern. So this is the one reason. What is this is the one negative point with the P note. Another negative point with the P note is that these P notes, they are the part of the FII. So they are the hot money. They are whatever money they are putting into India, they can get withdraw the money at any point of time. So they can demand the money immediately. So that can be risky for India's economic health, right? So this is about the participatory note. So just to recap the entire discussion that I did so far, this is the India's stock market. They are the small foreign investors. They want to invest into India's stock market, but if they go to invest individually, there are a lot of formalities they need to involve into. So rather than going directly into the India's market, they go to big investor, and big investor takes money from them. Big investor invests into India, it registers itself, and it issues participatory note to the small investor. The good thing is that small investors get an opportunity to invest into India, and India also gets a lot of foreign exchange. The negative point is that, number one, the profile of these individuals is not known to India's authorities. So that becomes a concern. The second problem is that they are actually source of hot money. So they can withdraw the money at any point of time, right? So this is about the participatory notes. Now read this language. So P notes or participatory notes, they are the instruments, right, issued by registered FII. Registered means the FII which are registered with the Securities and Exchange Board of India, SEBI, the regulator of the India's stock market, to overseas investors. So these overseas investors are basically those small investors who wish to invest in the Indian stock markets without registering themselves with the market regulator, the Securities and Exchange Board of India. So these overseas investors, they are not registering themselves, but there are some registered FII who, on behalf of these overseas investors, they are investing money into India. Now what are the concerns? Concerns about the P notes. Number one, concerns have been raised that some of the money coming into the market via P note could be unaccounted wealth, that is the black money, the money which is not accounted. So it can be unaccounted wealth, black money. Currently, mandatory reporting requirements for P notes do not capture details of owners, right? So they do not capture the details of owners, thus making the instruments vulnerable to misuse. An investor in the P note does not hold the Indian securities in his or her name. These are legally held by FIIs, but she or he derives economic benefit from fluctuation in the prices of India's securities, right? So the small investor, the small foreign investor is not holding the India securities in his or her name, but is getting the benefit from the fluctuation in the prices. Now, why I discuss this point? Because of the point number 4 and 5, right? So in the point number 4 and 5, you can see point number 4, foreign institutional investors should be prohibited from investing fresh money raised to participatory notes, right? So Tarapur committee is saying, please do not invite the fresh money from participatory notes. This kind of money is risky. existing PN holders, PN means participatory notes, existing PN holders should give an exit route to phase out completely the PN notes. So even the existing PN holders, they should sell. They should be given an opportunity. The point is that this PN note should be completely abolished. This is the point raised by the Tarapur committee. So Tarapur committee says that we do not need any kind of risk. Please remove all kind of risk before we can introduce the fuller capital account convertibility. Right? Now, what are the benefits of capital account convertibility to India? So Tarapur committee has also identified the benefits. First, availability of large funds to supplement domestic resources and thereby promote economic growth. Right? So basically, in India, we require huge amount of money for infrastructure building, for the projects like Startup India. Right? So today, every youth wants to have some kind of a startup. Youth just wants money. Right? So this money can really help Startup India. This money can help in Make in India. Right? So it will be supplementing the domestic resources. And if Startup India, Make in India succeed, the production will increase. If the production increases, that means the economic growth will increase. Improved access to international financial markets and reduction in the cost of capital. So this point I already discussed. Cost of capital will be substantially reduced. In the developing countries like India, the cost of capital goes up to double digit. But in the developed countries like USA, cost of capital is very, very low, around 2 to 3% only. So if we borrow from the foreign country, after the fuller capital account convertibility, we can actually reduce our cost of capital. Number 3, incentive for Indians to acquire and hold international securities and assets. So even we people can hold international securities and assets. So our global presence will enhance. The countries like China, how they are becoming big and big? Because they are acquiring international financial assets. They are acquiring international mines. So similarly, we Indians, the Indian companies, we should also acquire as much as possible the foreign assets. Next, improvement of the financial system in the context of global competition. So if more and more money is coming, our banking sector will also be strong. The capital adequacy norms will be kept. There will be less fall down of the banking system. Freedom to convert local financial assets into the foreign ones at market determined exchange rate. So we can convert our local financial assets into the foreign assets. So if I am having the share in the India's company, I can convert that share into the foreign company. Leads to free exchange of currency at lower rates and unrestricted mobility of the capital. So exchange of currency is very, very easy, and I can invest my capital in any part of the world, and any investor can invest in any part of the world. So that ensures optimum return for the investor and optimum cost of capital for the businessman. Now, what are the demerits? What are the demerits of the capital account convertibility, fuller capital account convertibility? So, the major demerit is that after the full capital account convertibility, there will be huge influx of funds into India. Right? So we are expecting that huge foreign exchange money will be coming into India. So this is a good aspect. This is a positive phenomena. What is the problem? The problem arises when suddenly the investors withdraw their money, and in India there is instability, right? So this foreign exchange will be coming into India, but the problem will arise when there is sudden outflow of foreign funds, right? When there is sudden outflow of foreign funds, that means the demand of the foreign currency like US dollar will enhance. If the demand of the foreign currency enhance and supply is not increased, then the domestic currency will depreciate, right? So it leads to the depreciation of rupee, and depreciation of rupee will be very, very adverse because we are an import dependent nation. Because of the depreciation of rupee, our import can increase suddenly and our current account deficit can increase suddenly, right? So the biggest problem is the volatility. Biggest problem is the instability it can cause into India's financial system. This is the biggest problem. This is the biggest problem. And this problem is not hypothetical. We can see this problem recently. This coronavirus issue is happening, and a lot of foreign investors, they are withdrawing the money from India. India's stock market is crashing like anything. In 1998, the same situation happened in the East Asia. The countries like not Southeast Asia, Southeast Asia. The countries like Thailand, a lot of money flew away from there because of they being dependent on the foreign capital. They allowed the fuller capital account convertibility, and suddenly something happened and the entire economy actually crashed. So this instability is the biggest problem. This instability is the biggest problem, right? So now you read this. So this first point is not that much important for you. You start from the second point. If not properly managed and monitored, market exchange rate may lead to depreciation of domestic currency, Indian rupee. If a currency depreciates heavily, the confidence in it is shaken and no one will accept it in its transactions. As a result, the trade and capital flows, trade means import and export, trade and capital flows in the country are adversely affected. Convertibility of a currency sometimes makes it highly volatile. So this is the problem, volatility, depreciation of the domestic currency. Operations by speculators make it more volatile and unstable. So speculators are the people who are looking for the situation where they try to gain from the fluctuation in the currency prices, right? Operations by the speculators make it more volatile and unstable and adversely affect confidence in the currency and capital flight. The Southeast Asian economies like Thailand, Malaysia, Indonesia, Singapore and South Korea in 1997-98, this problem they have already faced. Capital flight adversely affect economic growth and depreciation of currency discourages further inflow, right? So this is the biggest problem with the fuller capital account convertibility. So friends, now question arises that what should be the prerequisites before we introduce the fuller capital account convertibility. So there are some lessons which we can take from the Asian financial crisis of 1998. So for a developing country like India to benefit fully from the convertibility, we should ensure, number one, there is a comfortable current account balance. So if comfortable current account balance is there, that means in the current account itself there will be positive inflow of foreign exchange right. So comfortable current account balance means export is more than import, or we are actually receiving the foreign exchange on account of the current account. So we are no longer dependent upon the capital account. So capital account convertibility can benefit in such case. Number two, low level of external debt. So if the external debt is low, that means we don't have the obligation to repay outside India. That means we are independent. Even if foreign exchange goes suddenly out of India, we do not need to worry. So the volatility which is caused by the full capital account convertibility can actually cannot adversely affect our operations. Number three, a strong banking system that is resilient to global contagion, right? So we also need a strong banking system which can create enough credit, right? So the banking sector is basically the backbone of the economy because it provides credit to the industries and it acts as the source of income for the common people. Common people can deposit their money into the bank account and they can earn the interest income. So it is actually a place of meeting where the savers of the money and borrowers of the money, they meet together, right? So this is acting as the backbone. So current account surplus, low external debt and a strong banking system. These three are the requirement, and unfortunately none of these conditions exist in India today. So any of these three preconditions, none of them are satisfied in the context of India. So can we say that we are not equipped, we are not at the right place to introduce the fuller capital account convertibility? So you can read this. We have already discussed the primary benefits that India is likely to reap from full capital account convertibility are: number one, stronger capital flows into the domestic projects. That means we will receive FDI. Number two, lower borrowing cost for the firms. And number three, currency diversification benefits for the businesses and the investors. The foreign investors already enjoy full convertibility on most transactions, while rules for Indian firms make cross-border acquisitions or borrowings have been progressively relaxed in the recent years, right? So the foreign investors in the developed countries, there is full capital account convertibility. So they enjoy full convertibility, while in case of India, we have the partial capital account convertibility. Therefore, to make cross-border acquisitions or borrowings, there are regulations, and the good news is that we are progressively relaxing those regulations. Now the previous year questions, right? So I will give you 40 seconds each question. You take your time and then we will discuss the answer also, right? So your time starts now. So in this particular question, I will be intervening in between because the question is very, very simple. So this question do not require 40 seconds. Tarapur committee was associated with which one of the following? So this question came in 2007. So in 2007, this was basically in news. So for that time, this was a current affair, right? So you can see this is a basically current affair topic of that time, right? So Tarapur committee was associated with which of the one of the following? A. Special economic zone, SEZ. B. Fuller capital account convertibility. C. Foreign exchange reserves. D. Effect of oil prices on the Indian economy. So friends, please read each option carefully. Do not jump suddenly. Do not mark the answer suddenly. Right? Even though question is very, very easy, but still you should be careful while you are marking the answer. So in this case, the answer is option B. You get 40 seconds for this. Take your time and then we will discuss. So this question was asked in 2015. Convertibility of rupee implies option A, being able to convert rupee notes into gold. This is completely wrong. Option B, allowing the value of rupee to be fixed by market forces. So this is basically the flexible exchange rate regime. So this is also not convertibility. Option C, freely permitting the conversion of rupee to other currencies. Yes, so when we are allowing conversion of domestic currency into the other currency and vice versa, this is what we mean by the convertibility. So answer is option C. Still we will also read the option D, developing an international market for the currencies in India. So this is also not the right answer. So answer is option C. Next question. Again you get 40 seconds. So your time starts now. Consider the following statements. Full convertibility of rupee may mean, statement 1, it's free float with other international currencies. That means free exchange, no restriction on the exchange. So this statement is right or wrong? This statement is correct. Statement 2, it's direct exchange with any other international currency. So any currency at any prescribed place inside and outside the country. So this is also true, because full convertibility means the domestic currency can be converted into foreign currency and vice versa. There is no condition attached. Statement 3, it acts just like any other international currency. So this is not true, because full convertibility does not mean that it becomes an international currency. So international currency like US dollar, which is easily accepted, those are also called the hard currency, which are easily accepted and in which most of the trade is done, right? So full convertibility does not mean that Indian rupee can be easily accepted. It does not mean that the world trade will be denominated in the Indian rupee, right? So statement 3 is wrong. Which of these statements are correct? So answer is option A, 1 and 2. Next question. Again for this you have 40 seconds and your time starts now. Consider the following statements. Indian rupee is fully convertible. Statement 1. In respect of current account of balance of payment, yes. With respect to current account, Indian rupee is 100% convertible. Statement 2. In respect of capital account of balance of payment, so this is wrong, because in case of capital account we have partial convertibility, so statement 2 is wrong. Statement 3, convertibility into gold, this is also wrong. So it is not that we pay rupee and we get the gold. We can buy, but not that each and every penny, each and every note in this country can be converted into gold, right? So gold is not fully convertible, the rupee is not fully convertible into gold. Which of these statements are correct? Answer is one only, option A. Next question. So your time starts now. Capital account convertibility of Indian rupee implies option A, that Indian rupee can be exchanged by the authorized dealers for travel. So travel is basically current account transaction. So option A is wrong. Option B, that the Indian rupee can be exchanged for any major currency for the purpose of trade in goods and services. The trade in goods and services, this is again a current account item. So option B is also incorrect. So friends, can you see when I am reading the statement, I am underlining the keywords. If you underline the keywords, you can easily reach out to the conclusion. You do not need to struggle, right? So whenever you are reading the statement, please underline the option. Option C, that the Indian rupee can be exchanged for any major currency for the purpose of trading financial assets. So this is a capital account transaction, right? So assets is basically a capital account transaction. So Statement C is wrong. Statement C is correct. None of the above. This is also not required. So answer in this case is option C. So this is how you can drive the answer. Next question. The time starts now. One of the important goals of economic liberalization policy is to achieve full convertibility of Indian rupee. This is being advocated because, right? So what is the purpose of aiming full convertibility of the Indian rupee? Statement 1. Convertibility of the rupee will stabilize its exchange value against major currencies of the world. So this statement is wrong because convertibility will actually start more volatility. It will bring more volatility. So this statement 1 is actually incorrect. Statement 2. It will attract more foreign capital inflow into India. Yeah, this may be correct. This may be correct. Statement 3. It will help promote exports. Not necessarily. Not necessarily. Statement 4. It will help India secure loans from world financial markets on attractive terms. Right? So, option statement 2 and statement 4 both are equally, not equally, but both seems to be correct. So, in this case, which statement is more correct? Statement 2 is also correct. Statement 4 is more accurate because here the loan is available on more attractive terms. That means our cost of capital will be reduced. So this point I am highlighting again and again, that our cost of capital will be reduced because the developed countries like USA, their cost of fund is very, very less as compared to the developing countries like India. So in India, the cost of capital is running into double digits. We go to the bank and we will get the loan at 10%. But in case of developed countries, the loan is available at 2 to 3% also, right? So this is a major advantage which is, required. So we will go for the option 4, right? This is one more concept. Please read this. This is the concept of soft convertibility and hard convertibility, right? So soft convertibility means convertibility at the market determined exchange rate, right? So in case of the flexible exchange rate regime, the full convertibility is called soft convertibility. So what is the implication of soft convertibility? The implication is that because the exchange rate is market determined, so any fluctuation, the benefit of that fluctuation and the adverse impact of that fluctuation will be borne by the two parties, will be borne by the seller and the buyer itself, right? Now in case of hard currency, in case of hard convertibility, this is applicable in case of fixed exchange rate regime. That means the exchange rate is fixed but convertibility is allowed. So in this case, the risk is lying with the country which is issuing the currency, because the currency issuing authority has fixed the exchange rate. So whatever is the impact is going to come on that country itself. So take few seconds and read this slide. Soft convertibility entails the ability to freely exchange currencies at market determined exchange rate, while The hard convertibility entails right to freely exchange currencies at a given exchange rate. That means the exchange rate is fixed exchange rate.